Hello and welcome to the Scan the Markets webinar with myself, David Madden. I'm a market analyst for Equity Capital based in London, and Equity Capital is one of the many companies that are part of the overall equity group, including Equity Nigeria and also FX Pesa in Kenya. So what I'll do for this webinar, what I'll do is I'll run through 5 of the kind of major, most popular markets, talk about what news is driving the markets, and also talk about potentially interesting price points. I'll be covering a bit of fundamental analysis, essentially news, what's influencing the markets, and also a bit of technical analysis, which is essentially the study of charts. Just first and foremost, I'm looking here at the gold chart. The time frame that I've been looking at on our platform is the 4-hour chart, is a 4-hour time frame, and the 3 moving averages that I have here on my screen, these 3 lines here, 1, 2, 3. The 3 moving averages are the 20 period, they're all the 3 simple moving averages, the 20 period moving average, the 50 period moving average, and the 100 period moving average. Now, starting off with gold, we can see here that the longer term trend for gold is clearly much lower. In fact, it was only almost 2 weeks ago, gold fell to its lowest level. I think in several months. I think it was its lowest level since February was achieved in the middle of May. And this was largely down to the fact that back then the US dollar was very, very strong. The US dollar was at a 5-year high, and that drove gold to a multi-month low. So there's often an inverse relationship between the two assets. What we've seen more recently is that we've seen a decline in the US dollar. We've seen a decline in the US dollar. Weakness in the US dollar has in turn pushed up the price of gold. So gold, you can argue, was cheap, and it was a bargain hunters were stepping in, but also the change in sentiment and the dollar has greatly influenced the price of gold recently. So since then, we've seen a higher high, a series of higher highs and higher lows. Although we've kind of retreated from the recent peak, and the lows we set in the last few hours have actually dropped below the most recent lows, but they're still above the lows of last week. So looking at the price action, what's been going on with gold more recently? Well, I can see what I've written here was the Fed were less hawkish than feared. Last night, the minutes from the most recent Federal Reserve meeting were issued, and even though earlier this month the Federal Reserve hiked interest rates by 50 basis points, meeting expectations, and even though the last night's minutes showed most of the members of the Fed, it looks as if the Fed could be hiking interest rates by another 50 basis points next month and another 50 basis points in July, which is quite hawkish. The overall thrust of the update wasn't as hawkish as feared. So things are hawkish, but not as bad as feared. And with that, we've seen a bit of a move lower in the US dollar. As I mentioned, a weak dollar can often assist gold. But what's also playing into gold is the kind of wider risk-on sentiment. So very recently, when we had periods of when the gold market was very, very strong because of the strong US dollar, because of fears about multiple interest rate hikes being in the pipeline of the Federal Reserve, that weighed on stock markets. But since then, in the last 12, 24 hours, we've seen a rebound in stock markets. We've seen, I'll come on to the S&P 500 in a second. The S&P 500, the last time I checked, was up 1.5, 1.8%. The NASDAQ was up over 2% the last time I checked, with strong gains in US stock markets. So with that, people were taking on more risk. They're in kind of risk on mode. And when traders are in risk on mode, what you typically see is stock markets and industrial metals such as copper and platinum, palladium, those tend to rally. But when traders are in risk off mode, assets that are deemed to be low risk, such as the Japanese yen, the Swiss franc, and gold, they tend to outperform. So the fact stock markets have been rising the last 12, almost 24 hours, that's actually kind of almost like impacted typical demand for gold, because traders are going, you know what, I want to plow my money, I want to take my money out of lower risk assets such as gold and invest them in higher risk assets such as stocks. Why is this? Because once again, the Fed aren't as hawkish as feared. People were thinking, oh, we're going to have a series of 50 basis point hikes from the Fed. It now looks as if they're going to be a couple, and then things could be paused for a while. So overall, stock markets are performing better in the past 24 hours, and therefore there's less demand for gold. So what we need to figure out is, and which we need to figure out is, what's going to be the next price action for gold? You know, as I said, for the last almost 2 weeks, the gold's been in an upward trend, which has been a rebound, a reaction to the broader bearish trend. So, but essentially, my view is that while gold continues to hold above this zone here around 1832, it's possible, you know, the more medium-term upward trend will continue. If you draw a kind of basic trend line in here from the lows here, you know, basically while gold continues to hold above this line here, it's only, you know, a tentative trend line because there's only 2 points on it. If gold can continue to hold above that metric there, it's likely the kind of broader bearish, the kind of broader bullish trend will continue. So if you can hold above this trend line here, I suspect that the kind of broader upward trend will continue. I'll be more optimistic and more bullish on gold if gold were to retake these 3 simple moving averages. At the moment, we're trading above, you know, 1 or 2 moving averages. If we can retake the 100-period moving average, this dark line along here, that'll be more significant, suggesting that the bulls are in control. Looking at the MACD indicator, we can see that momentum is in negative territory, but negative momentum is in decline. So it suggests, although the bears are currently kind of in control, they're not as influential as they once were. We can also see a bit of a tick higher in the RSI as well, the relative strength index, which essentially kind of a measure of, once again, with a measure of change of how quickly a price kind of swings from A to B. If we do manage to rally from here and we clear the most recent peak, which was set during the week, and it was the highest level in almost 3 weeks. If you clear that level, I'll then be looking out for this zone here around 1892, and a break beyond that could see us up toward this peak here around 1909. Conversely, you know, we can't ignore the fact that the much longer term trend for gold has been lower. We can't really ignore this trend here. You know, typically you would defer to the longer term trend. Usually takes precedence over the short term trend, but in order for that to happen, it also depends on your time frame. If you're looking at where's gold going to be in 5 minutes, 1 hour, or in 1 week. So these things need to be taken into consideration. But obviously trends can turn around. So when we have a rally here, is it a case of gold has pulled back before it forms a base here and continues to zigzag higher again, or is gold will go find it difficult to break above this trend line here, this resistance line rather here, and actually just move lower again and look to kind of fall back below this trend line and retest 1832, retest 1810, and then head back down towards the multi-month low that was set almost 2 weeks ago, and that multi-month low was 1786. So watching out for these levels to the downside. For gold, coming on now to euro dollar. So there's a few things going on here. As I mentioned, in the last 12 to 24 hours, the US dollar has been broadly weaker. It's also been broadly weaker the last few days, the last week or so. You know, when I mentioned that the US dollar hit a 5-year high on Friday, on the 13th of May, almost 2 weeks ago, euro dollar was at a 5-year low. But since then, we've seen a rebound in euro dollar. Once again, we've seen a series of higher highs and higher lows, as demonstrated all along here. You know, while euro dollar continues to hold above these 3 simple moving averages, it's likely the more medium-term upward trend will continue. Moving higher from here, where can we target? I've been looking toward this area in at 1.0814, and a break beyond that could see us up towards the highs of late April around 1.0935. Looking at the price action, you know, we can see the more medium-term trend is certainly higher, but let's not forget the much longer-term trend, if you zoom out here, is clearly lower. You know, so although we've hit a 1-month high recently, that in itself could be the sign that we might be in the early stages of a wider turnaround, or it could be a case of we just have a large rally, after a brutal sell-off before the market kind of runs out of steam and turns lower again. Keep in mind, just over 2 weeks ago, euro dollar rather fell to a 5-year low. So we can't ignore the fact that the much broader trend is to the downside. So if euro dollar fails to retake the recent peaks here at this area around 1.0745, 1.0750, if you fail to retest or reclaim that area, that could be the kind of early warning sign to say the kind of broader bearish trend is still in effect. If you do move lower from here, where could we potentially find support? Where could we target? We could find support from the recent low here in at one spot 0641. Notice how the support area here seems to be coming into play from the 20-period moving average. It acted as support here, sort of acted as support here, it acted as support here, it acted as resistance here. What I often talk about is looking at price action in the past to try and predict what's going to happen in the future. If you look at this moving average here, you can see on several occasions it acted as support. And what I often say for those of you who have attended my webinars before, if a metric has been of importance in the past, it makes it more likely to be of importance in the future, although there are no guarantees. So this entire zone here with the 20-period moving average is around one spot 0675 down towards one spot 0641. That kind of 30 pip zone could act as support. If you have a fairly large move lower beyond this recent low here, where could we target? Well, we could potentially target this simple moving average here, the 100-period moving average. This general zone here acted as support. It acted resistance here. It acted resistance here. You can follow it around. It didn't act as an amazing resistance here. Kind of active resistance here, not quite though, but it certainly acted as resistance here in early April. So once again, if a metric has acted as a resistance point and or support point previously, there's an increased likelihood it will do it in the future, but there are no guarantees. So I'll be watching out for one spot 0597. The point we're looking at here with euro dollar is we need to ask ourselves the question: what's going on? Are we going to see a continuation of this kind of upward trend? The more medium-term uptrend, is this going to continue? This is a basic trend line drawn in here. Is the more medium-term upward trend going to continue? Are we going to see a continuation of zigzag, higher highs and higher lows, or is the much broader bearish trend going to prevail? And obviously, it depends on what happens in the price action in the next few days. Really, are we going to continue moving higher, or are we going to turn lower on ourselves and going to break below these areas that I talked about? Looking here at the US 500, the S&P 500, what's been going on with the S&P 500? Well, we can see here that, as I mentioned, it was a traders are in risk-on attitude. The Fed were less hawkish than expected. So part of the reason why the US 500 last Friday fell to its lowest level in 15 months was because precisely of fears that there are going to be several large interest rate hikes from the Federal Reserve in the pipeline. It looks as if there are two large rate hikes from the Fed in the pipeline, but traders were fearful that there'd be even more. So that was why the markets were driven last Friday to a 15-month low. But since then, we've kind of had a bit of rebound. And in the last 12 to 24 hours, we've seen a kind of more money flow into the market because people are saying, okay, interest rate rise. We're looking like a couple of 50 basis point hikes on the radar, but we were predicting it is going to be even more. So in that kind of scenario, it's not as bad as expected. So traders aren't as fearful as they were expected. Hence why they're now swooping in, buying up stocks. So we can see here the US 500 is at its highest level since the 18th of May. So we're talking about not quite a 2-week high, but certainly a week and a half, 10-day high. That in itself is interesting. We can see here that the MACD indicator, we can see these green histogram bars here, they're steadily increasing. So not only is momentum in positive territory, it's actually increasing. So the bulls are becoming even more influential. They're certainly in control. If you continue to hold above all three simple moving averages here, it's likely to get, this recent upward trend will continue. A rally from here could target this peak here at 40.97, and a break above that could target this zone here around 41.58. Now, as I mentioned a few minutes ago, what I often like to do is look at previous price action and then try and use that as a predictor for what's going to happen in the future. So we can see here that we've managed to break above all three simple moving averages, and we're actually quite comfortably above the 100-period moving average. And I think that's interesting because the last time we had a fairly large rally here was in the middle of May. And notice how when we did rally, we didn't even actually get close to retesting the 100-period moving average, let alone actually breaking above it. We can see here in early May, when we had a fairly steep rebound here, the market essentially didn't quite, it almost perfectly acted as a resistance zone at the 100-period moving average. It got just ever so slightly above it, only to turn lower, and then within a few days, it was actually had taken out the previous low and it set a new, 12, 14-month low. So it's interesting to see that we're actually comfortably above that moving average. But then again, if we go back to late April, we can see here we were well above, we were comfortably above the 100-period moving average. But did that mean the market turned around and kept on going higher and higher forever? No, it didn't. The market turned lower within a few days. So this is what I mean about, this is why trading is difficult. There's no kind of cast iron guarantees. If we take the 100-period moving average, the market's going to go higher. On a few occasions, it's broke above the moving average, only to turn lower again. And on other occasions, it has managed to kind of clear the moving average and continue. So this is what I mean about be careful of what's going to happen. Adding to that, looking at the RSI here, we can see it's moving higher, and we can see the RSI here is just about approaching overbought territory. We're coming up to a reading of 69.17, a reading of a 70 or above denotes the market's been overbought. Essentially, it's kind of overstretched to the upside, if you were. Now, the last time we kind of got close to overbought territory was actually this period here in late April, and you can see that was around the time the market moved aggressively higher. Didn't actually quite get into overbought territory, but got quite close to it. And only what happens next, that the fact that we had a spike in the RSI and got close to being overbought preceded this sharp move lower. So will we see something similar again? But it is worth pointing out, though, that from a fundamental point of view, a lot of the reason why the markets were enduring this very aggressive sell-off to begin with was to do with the fact that traders were fearful we were going to have several, 50 basis point hikes from the Federal Reserve. Now it looks as if we're going to have two, but but that's still lower than originally feared. So this could be the beginning of the market actually turning around from here. Perhaps it isn't. Perhaps it fails to reclaim 41.00 and then turns lower. If that is the case, and we do move lower from here, I've been looking towards this trend line here as a potential area of support. That comes into play in around 39.66. If you have a very large break below that, I've been looking toward this area, this point here in the trend line at 38.73, and a break below that could see us down towards 38.10. Coming on now to the UK 100. So the UK market has been in much better shape than the S&P 500 and the American market. Why is this? Well, it's to do with the composition. The S&P 500 in the US has a fairly high percentage of tech stocks. Tech stocks have been getting hammered recently, and therefore the falls of the S&P 500 have been relatively large. The UK 100, the FTSE 100, has a fairly large composition of mining stocks, which have been performing well, oil stocks, which have been performing well, banking stocks, which have been performing well, and utility stocks, which have been performing well. So with that, notice how we've actually hit its almost, a 3-week high has been set. We're now back up to levels last seen on the 4th of May. Today is the 26th of May, so we're talking a 22-day high. We're talking just over, we've managed to eke out a 3-week high on the FTSE 100. Compare that to the S&P 500, which is only at a 10-day high, and it was only last week we were at a 15-month low. So compare and contrast. The S&P 500 this time, a week ago, was at a 15-month low. Where was the UK 100 this time last week? Granted, it was lower than where it currently is, but still, the lows that we saw last week were comfortably above the lows of mid-May, and they were comfortably above the lows that were set in early May. So we can see a series of higher lows forming here. So it's clear that the UK 100 is in much better shape than the S&P 500. So while the UK 100 continues to hold above these three simple moving averages, it's likely the kind of medium-term upward trend will continue. A rally from here could see a target 76.21, and a break above that could see a target 76.56. Looking at the RSI here, it's moving higher. If it continues to move higher from here, it might move into overbought territory or get close to it, but actually turn around. If that is the case, if you do move into overbought territory and we do have a sharp move lower in the RSI, that could be the kind of warning sign that the market's about to move lower. If we do move lower, where can we move lower from here? Well, I've been looking towards this low here in around 74.42. if you follow this moving average here, the 100-period moving average, the darker of the three lines, you can see it acts as support here. It acts as kind of a consolidation zone here, and actually on a couple of occasions support in the last few weeks. Not a huge amount, but nonetheless, it has acted as support recently. That moving average comes into play at 74.42, and if you have a very big break below that, where can we look to head back down towards? Well, perhaps this area here around 74.02. Coming on now to the Japanese yen, sorry, the US dollar versus Japanese yen. There's been a few things going on here. So in the more, as I said, the Federal Reserve in the past 24 hours were not as hawkish as originally predicted. So with that, we saw weakness in the US dollar. Now, what's also been going on in the kind of much wider scheme of things, as I mentioned a few charts ago, the US dollar itself the US dollar index hit a 5-year high almost 2 weeks ago, but it was at a 5-year high against the euro, but the US dollar hit a 20-year high against the Japanese yen. So the really big picture, the really big picture, in the grand scheme of things, USD JPY was at a 20-year high only about 13 days ago or so, or 2 weeks ago. Since then, we've seen a retreat. We've seen the market move lower. Markets don't move in straight lines, is the old adage. What have you seen since after hitting a 20-year high at the beginning of the month? A lower low, a lower high, a lower low, a lower high. You can see a clear kind of downward channel, forming along here. And it's showing a couple of trend lines. Just going to show the kind of basic outline of what's been going on. So the really big picture for dollar yen is still higher, but the more recent kind of medium-term move is lower. The question we have to ask ourselves is, what's going to happen? Is this medium-term downward trend just a kind of a pullback in the much bigger trend? So when you look at a daily chart now, you look at this on a daily time frame, you can see that in the grand scheme of things, the more recent downward move of the past 3 weeks isn't really that big compared to the whopping rally that we saw here, especially from early March up until mid-May. So this goes to show you always need to be looking at a longer time frame to kind of find out what the big picture is, because I'm looking at a 4-hour time frame here, and it seems quite obvious. When you look at this, we're below all three moving averages. We've clearly seen a series of higher highs and higher lows along the way. It was only a few days ago we were back down to the levels last seen about 1 month ago. So that picture there on this 4-hour time frame seems quite bearish for USD JPY. It absolutely does. But if you look at it on a daily chart, you look at it and you go, wow, we actually, fair enough, we've pulled back from 131.40ish down to 127.30. We've dropped about 400 pips, which is a lot. But when you compare that to the fact that it's actually managed to rally 1,600 pips since the beginning of March, it's really puts things in perspective. So in the near term, I'll be looking at this and saying to myself, right, while dollar yen continues to hold below all three simple moving averages, it's likely the more medium-term bearish trend will continue. Moving lower from here, I'll be looking down towards this area here, this peak here on the way up at 126.31, and then below that down towards this area here around 124.75. These are the areas I've been looking out for to the downside. But even though I might hold a more medium-term bearish view on dollar yen, you always have to be kind of looking over your shoulder, as it were, and keeping an eye out on the much bigger picture and saying, right, even if dollar yen does go down to 124.75 or even down towards somewhere like here, 121.30, the much longer term upward trend is in effect, because there are always trends and trends. So, I would trade and look at longer time, time charts, 4-hour charts, and then daily charts and weekly charts. I fully understand that some traders will look at 5-minute charts or a 1-hour chart or whatever it might be. But regardless of whatever time frame you typically trade off of, if you regularly trade off of, say, 5-minute charts, if that works for you, great. But always be mindful of the fact what's going on in the bigger picture. If you're trading off of 5-minute charts, always keep an eye on, say, the 1-hour chart or the 4-hour chart, because for all you know, there's a glaring trend that you don't see, which could essentially sneak up on you, as it were. And this is what I mean about some people might just kind of lock themselves into a bearish trading strategy along here, not realizing we're in a massive upward trend. And for all we know, this medium-term bearish trend might run its course, and then the market could turn around and fall back into the much longer trend. Because as I said a couple of charts ago, typically, but not always, the longer-term trend usually takes precedence over the kind of the medium and shorter-term trend. What's also going to be interesting at dollar yen in the next few days is a few things going on here. I talked about risk on, risk off attitude earlier on, and whenever traders are in risk off mode and they're typically selling stocks and they're selling industrial metals and they're selling oils, they typically buy assets that are deemed to be lower risk, such as gold, the Swiss franc, and the Japanese yen. So part of the reason why the USD JPY was moving lower recently was because a few minutes ago I showed you how the S&P 500 last Friday fell to a 15-month low. So sentiment in US stocks only at the end of last week was very bearish. And when sentiment was very bearish, what did we see here? We saw USD JPY in a downtrend because people were selling their shares looking to buy the Japanese yen. Now things have turned around a little. Now that the Federal Reserve aren't as hawkish as initially feared, fair enough, the US dollar is a bit weaker because of that. But at the same time, stock markets are much stronger because the Fed were just as hawkish as originally predicted. So with that, if we continue to see a rally in stock markets, what's that going to do to the Japanese yen? And this is what kind of I made the comment here of strong yen. So I know some people out there, people are often kind of stuck in their kind of silo of, oh, I trade currencies and I never trade indices, or I trade metals and I never look at indices. The financial markets need to be looked at as a whole, because if you trade any currency pair that has the Japanese yen in it, any yen crosses, it's seriously worth your while keeping an eye on what's going on with global stock markets. Even if you don't trade the S&P 500 or the DAX or the Nikkei or whatever it is, please keep an eye on what's going on with global stock markets, because you'll have days when stock markets will fall through the floor and the yen will rise. And you'll have days like we saw today where stock markets will enjoy large rallies and the yen will either be muted or the yen will actually fall as a result. Now, today's an unusual one because stock markets are rising because the Fed weren't fearful. So therefore, the yen in theory is a bit weak. But at the same time, dollar yen is kind of muted because the US dollar is weak. Why? Because the Fed were less fearful than originally expected. So that's why it's a bit of a strange one. So in the next few days, I wouldn't be surprised if we see dollar yen trading in a smallish range, because we could continue to see a weak dollar, but we could also see strong stocks. And if we see strong stocks, we'll probably see a weakish yen. So we could have the dollar and the yen almost like weakish together. I got a couple of questions were asked here. See you now. Hi, David. Please review all US indices. So I've covered the US indices. Has stocks bottomed or risk of recession rates? Has stocks bottomed or risk of recession and rate hikes will reverse today's gains? I kind of covered. I'll take a look now at once again at the S&P 500. What I will say is this. This is why I said, and I mentioned it a second ago with the Japanese yen, when I was talking about dollar yen. Things are interesting now in relation to the Federal Reserve, because although we are expecting 2 more large rate hikes from the Fed, that's still not as many rate hikes as the markets are pricing in. So going back to the S&P 500 here, it fell to a 15-month low because the markets are pricing in 3 or 4 big rate hikes. Now it looks as if we're only going to get 2. I say only going to get 2, but it's all about expectations versus reality. And now we're seeing a turnaround in stocks. I think it's too early to kind of call, say, have we seen the bottom just yet? But I'm very interested to see if the US 500 can break above this area here around 41.00. And why is that? Because if you look at the price action in the last few weeks, it's always struggled to kind of break above previous big peaks. We've seen a nice clear example of lower lows and lower highs. We had the lower low, the lower high, the lower low, the lower high. The peak here didn't really clear this peak. We created a new lower low here, creating a 1 month low, or sorry, 1 year low. Granted, just about the highs that we set here were fractionally above these 2 highs that were set along here. But let's be honest, not really by a huge amount. This essentially was the entire resistance zone. It also was pointed out that these two resistance points here were kind of reinforced by the fact that we had a moving average thrown into the mix as well. So when you have several kind of potentially important metrics overlapping, two strong resistance zones and a moving average, it makes it even more important, because essentially some people follow resistance, some people follow moving averages. When you combine the force of them, it becomes even doubly important. So it's interesting that we never actually broke above previous peaks, really, anyways. Fair enough, the peak that we saw here was above these peaks, but we didn't get anywhere near retesting this level here. But now, this is the question I'm asking. We're very close to retesting this peak. We're above the moving average. What's going to happen next? One possible scenario is that the market breaks above this peak here, which would go on to create about a 3.5 week high, which would be fairly significant. Could we see a bit of a pullback? And if we do see a pullback, will we actually find support from the 100-period moving average? And could this be a base for kind of future kind of zigzag higher, a series of higher highs and higher lows? I wouldn't be surprised if we do see a bit of a rally from here, just because the fact that the fears about higher interest rates seem to have been overdone, and therefore we have a bit of a correction. But we're not out of the woods yet. We've had 2 interest rate hikes in 3 months from the Fed, and it looks as if we're going to have we're going to be a full 1% higher in about 2 months time or 10 weeks time. That's going to trickle down to overall demand. That's going to make private individuals who have to make mortgage payments, car loan payments, all the rest of it. Business loans business borrowing is going to be more expensive. So I wouldn't be surprised if there's both. I wouldn't be surprised if you kind of rally up towards this area here, but then actually to kind of either encounter resistance there or even drift lower again, because although we dodged a bullet last night, as it were, in terms of the Fed word as hawkish, but we're still looking at 50 basis point interest rate hike next month and the month after that. What's going on? Quickly take a look at the UT 100. Similar situation. The UT 100, a series of lower lows and lower highs. The low we saw, the most recent low we saw on the UT 100, the Nasdaq, was an 18-month low. Once again, if you follow the price action round, what's going to be very interesting is that, can we break this moving average here? The 100-period moving average acted nicely as resistance here in early May. It acted nicely as resistance here in late-ish April. It acted nicely as resistance here in early April. So at least three big occasions, the 100-period moving average has acted as resistance on the UT 100. Is it going to act as resistance again, or is it or else are we going to break higher? This is what I'd be looking at. And if we do break higher, I'll be then looking out for this zone here. The peak here in the middle of May, and you can see didn't quite act as resistance, but got close to it, and it's sort of acted as kind of, broadly speaking, a consolidation zone, support and resistance. So we're coming into potentially important levels on the UK 100, so the UT 100. To be honest, it's only really if I was to get a break above this area, whatever that is, somewhere in the region of around 12,560 or so, 12,570, thereabouts. It's only then when I look to think, right, now would actually change my view to a more optimistic one. But we're coming into some very important levels. And for me, the UT 100 is the one to watch, because the sell-offs that we've seen recently have all been tech driven. So if the tech is rebounding the most, then you can be more confident of the S&P making a decent recovery, and same with the Dow Jones. Speaking of the Dow, I'll come on to it now. Another one of the aspects I like of technical analysis is Dow theory. And one of the tenets of Dow theory is that the averages must confirm each other. And what that means is markets that are quite similar in theory should be moving in a similar direction at the same time. We've talked about how last Friday we had a 15-month low on the S&P 500. We had an 18-month low on the UT 100, but we're now seeing the markets turn around. We're now seeing both similar markets turn around in a similar fashion. So therefore, if you're trading the S&P 500, keep an eye on what's going on the Nasdaq. If you're trading the Nasdaq, keep an eye on what's going on the S&P 500, because ideally, if whatever view you hold, be it bullish or bearish, in theory, the other US indices should be moving in the same direction at the same time by thereabouts a similar-ish amount. And if that is the case, you can then be more confident of your position. But once again, there are no guarantees. The US 30, where is it now? So US 30, the Dow Jones, very similar situation to the S&P 500. We fell to, if it was a 15-month low last week, what have we seen since then? A series of higher highs and higher lows. We've smashed above the 100-period moving average. We're actually quite close to retesting this moving average, this peak here. So once again, we're actually coming up to, we're right here, right now, a very important level on the Dow Jones. Because as I said previously, if you look at the previous peaks here, none of them were ever retested or none of them were ever breached whenever we had a rebound. Are we going to do it this time? And this would be the telling point. Put it this way, if the big three US indices all clear their previous peaks, they're all respective peaks, then you can be more confident that we've seen the bottom and the market's going to go higher from here. How high will it go? That's a different story. I think given the fact that we've had interest rate hikes and we got 2 more in the pipeline, it would be unlikely that we're going to get back up to the all-time highs that were set either in January or December or November. But I wouldn't be surprised if we pull back a fair amount of the ground we've lost in the last few weeks. Levels to watch out for on the Dow Jones. This area here, just north of 33,000, in at 33,500, and the next big level beyond that will be this peak here at 34, just shy of 34,100. On the downside, if all 3 indices fail to reclaim their recent peaks here and actually turn lower again, where would I be looking to head down towards? First and foremost, I'm looking towards these 3 simple moving averages, the lowest of which comes into play in around 31,900, and then below that, I'm looking down towards this zone here around 31,360. A Bloomberg survey on top economists and possible bottom level of the S&P 500 majority, i.e. 20%. A survey by Bloomberg on top economists on possible bottom level of the S&P 500 majority, i.e. 28%, predicted 3,400 to 3,600. Technically, is this possible? I don't fully understand the question. Was the question that 28, as the market was falling, 28% of the top economists said the bottom would be between 3,400 and 3,600. Is that the question is? But as we can see here, the lows that we got to were just north of 3,800. So we didn't even actually get as low as 3,600 or let alone as low as 3,400. We got as low as just north of 3,800. Got a question here about the moving averages. So yes, so which percent? I'll go to the UT 100. So I'm looking at a 4-hour chart here, and I have 3 moving averages on my screen. This one here, the shortest one, is a 20-period moving average. This one here is a 50-period moving average, and this one here is the 100-period moving average. And why I reverted back to the UT 100 is because if you observe the price action in relation to the moving average, you can see which moving averages have been of importance in the past and which ones haven't. So, for example, the one to really watch out for is the 100-period moving average. We can see in the grand scheme of things, the 100-period moving average kind of almost acts as resistance here. It acts as a consolidation zone here. It acts as resistance zone here. It acts as resistance zone here and here. It acts as resistance here, here, here. So there's several occasions the 100-period moving average has acted resistance in the last couple of months. So, looking at past performance is no guarantee of future performance, but people tend to look at what's happened in the past and use that as a predictor for the future. We're now right up against that moving average. What do you think is going to happen? Do you think we're going to break above that moving average and then the previous resistance moving average will then act as support, or is it going to once again act as resistance, and are we going to be heading lower? This one you need to be looking at. It's also worth pointing out on the RSI, that's been moving aggressively higher. If it continues to move higher from here, it might move into overbought territory. Should that be the case, that could be a warning sign that the upward move has been overstretched. Look at the price action. The last time we got close to that 100-day moving average was in this occasion here in early May. You can see the market, the moving average moved aggressively higher here. It didn't actually get us quite actually into overbought territory. It got closest to it, only to kind of turn lower again, and that preceded this downward move in price. So could we be in for something similar again once again? I hope that that answers your question. I'm aware now that I've been speaking for over 40 minutes. I'll look to wrap things up there, unless of course there are any last minute questions. Okay, I'll look to wrap things up there. So everyone, thank you for tuning in. Before I leave you, first want to show that I have an account on Twitter. I'm very active in terms of tweeting throughout the day. I tend to kind of tweet financial news, interesting charts. Obviously, I can't give any advice or anything like that, and I won't give any advice. But what I can do is I can comment on the price action of a certain chart and talk about certain interesting levels to the upside and to the downside. My Twitter handle is @dmadden_equity, @DMADDEN_EQUITI. Feel free to contact me on Twitter. Feel free to follow me. I'm just going to go, hey, David, how's it going? What do you make of S&P 500, or what do you make of euro dollar, or whatever it might be? Once again, I can't give any advice, but I can provide commentary on what's going on in terms of the news, and also to discuss price points that I think could be of interest. So once again, I want to thank you for your patience. So everybody, have a good evening and have a good weekend. Thank you very much.